Namaskar. Now we are going to discuss income tax on salary income series. Some 4 videos I am planning to release to discuss all aspects of income tax calculations. Now this is the time for final calculation of income tax. Normally November, December the salary calculation will be along with income tax for even the borderline people. For other people throughout the year tax calculation and tax recovery will be done. So we'll discuss all these points in the next 3-4 videos. Now, the income tax calculation on salaries and other income for the assessment year 2024-25 relevant to the financial year 2023-24. Always the financial year will be the preceding year and assessment year will be the following year. So now our financial year is now 2023 and 24. So it starts from April 1st, 2023 to 31st March 2024. So this year income will be assessed by income tax department next year. We will be filing the return by end of June of next year. Then they will start assessing. Now all these things are done by online system. So that is why it is called assessment year. The income of previous year is calculated assessed in the next year. For the assessment year 2024 and 25, all the earnings from April 1, 2023 to March 31st, 2024, other than those exempted, are calculated for arriving at income tax liability. So once you calculate the liability, you make it average, make average divided by 12, and every month tax has to be recovered. For borderline people, of course, normally people do in the last 3-4 months because sometimes they may not be within the tax liability also. But all other people, if an average 100 rupees can be recovered, then you have to make throughout the year. No, there are 5 types of income which are taxed under income tax. Income from salary, one. This we are going to see now. Along with salary, income from house property, that also we'll be seeing. Income from profits and gains from business or profession. This is for private people. This includes, other than corporate tax, all the business, etc. we'll have to see in this only. So income from profits or gains from business or profession. This will not be applicable to salaried class people. If required, 1 or 2 brief points we will make, otherwise we will skip. We will see as it turns out. Income from capital gains. What is capital gain? We will discuss in detail. Suppose you have stock and sell it after 3 years. So whatever gain you make comes under long-term capital gains. If you sell same year, I think for stocks it is same year. If it is sold within 1 year, it is short-term capital. So that is normal tax. All those details we will discuss. And long-term capital gain, it is indexed against price rise. That also we will discuss in detail. And suppose you get a house or land and later on you sell it off. Again, it comes under capital gains of long term. So those calculations also we'll discuss separately. Now, last one is income from other source. Any income which are not indicated above: salary, house property, profit or gains from business or profession, and capital gains. Leave aside all those. So interest and all will come in this. Not only interest, there are many other things. So all those things we will discuss one by one. Now, income tax calculation is done based on the assessee's status, whether he is a resident or non-resident. We'll see what is resident and what is non-resident. Normally, government employees and private who are working here, those who are in the country 50% of the time, that is more than 6 months. That is strictly speaking 182 days above. In a particular, suppose if this year a person stays in India uh, at one stretch or the frequent stay, it means he is going abroad and coming back or something like that. There are people who travel extensively. So if they stay in India for a particular financial year more than 6 months, they are considered to be resident. If they don't stay, there is some conditions. 4 years, we'll discuss. In this video only we are discussing. So non-resident, the income tax treatment is slightly different. We'll see. So in case of resident taxpayer, all his income would be taxable in India. Resident, whether you get it from India or outside also, you have to pay tax here, irrespective of the fact that the income is earned or has accrued to the taxpayer outside India. Here I have written outside India, but inside India automatically, when you get in India, you have to pay tax. But you get something you have done for other countries, the company which is in other country, but you are in India. So you get an income from other country. Still you have to pay income tax based on our income tax. That is for resident. However, in case of non-resident, all income which accrues or arises outside India would not be taxable in India. So non-resident, if a person for a particular year stays, that we are seeing now, I'll show you the slide and tell clearly. An individual is said to be resident in India in any previous year. Why it is previous year? Because assessment is done the following year. That is why it is written as previous year. So suppose if, let us say, this year some assessment is done. So last year if the person was in India or not, they have to see. So this year if the person is not here or not, will be seen in the next year. That is why in 24-25 assessment year, the current financial year of 23-24 will be taken into account. So the previous year is like that. So if the person, an individual is said to be resident in India in any previous year, if he is in India in that previous year for a period or periods, that is at one stage or at multiple stage, amounting in all to 182 days or more. That is exactly 50% or more. 365 days are the are 365 days make 1 year. So in that half you make 182 plus 182, 364. So more than 362 or more. Okay. So if a person stays in India, he moves around, let us say. 1 month he stays here and then goes away, then comes after 2 months, stays here some 2-3 months. So every period you have to calculate. How it will be calculated? From the time of landing in the country and then from the time of going away from the country. All these things will be calculated number of days. So because if people earn not only in India, they earn outside. So we have to see whether they are resident of India or non-resident of India. Non-resident, if they earn outside, it is exempted. Only they earn in the country, that is taxed. That is why all these conditions. So that is first condition. Now, the previous year, this let us say the previous year is a financial year which is 2023-24. The person was only some 2 months, let us say. So by default, he is not an Indian, a resident Indian. He is a non-resident Indian. Okay, but still, in the last 4 years, the person stayed for 365 days. So let us say each year some 3 to 4 months he is staying. So every year, the last 4 years, if it is not adding to 1 year, 365 days, he will be considered to be non-resident Indian. Suppose every year he is staying 2-3 years. So fourth year he stays only 2 months, minimum 2 months or more. So all totals of the last 4 years, it comes to 365 days. He is resident. So for that particular year, he will be considered as resident. and any earning he made outside India also will be taken as resident, taken as income taken for calculation of income tax. If it doesn't match, he is a non-resident. So any income earned or accrued outside India will not be calculated for tax for a non-resident. Now, non-resident. Suppose, so he is not staying in the country for one particular year, 6 months or more, or in the last 4 years, 1 year total, and in the last year at least 2 months. He is not there, so he is non-resident. So in that condition, the income which accrues or arises in India, what is accrual and actual? Accrual is he is due to get. You take our DA, a simple example. So our DA accrues from January and July of every year, but we get from April and September or October. So now January of 24 accrued DA will be paid only in April. For government servant, see, if you take accrual, you can take everywhere. So otherwise, government servant, we take only actual basis. So that is why DA for January, February, March, whatever we get arrears is paid in April or May. So it is taken in the new year only. So it is actual basis. In private company, for double entry bookkeeping, accrual is also has to be taken into account. So if income accrues in India, he is a non-resident, he has to pay tax. Deemed to accrue, certain condition we will discuss, he has to pay tax because it is deemed to have accrued in India. So he has to pay tax. He has received, actually received in India. When it accrues, you pay, then actually received, you have to pay. But not on both the time. For accrual ones and actual one, there is no need. Either one only will be taken into account. Because there can't be double tax. Income which is deemed to be received in India, deemed receivable, again it is taxed. Now, income accruing outside India from a business controlled from India, he is a non-resident because hardly he stays for 2 months or something, less than 2 months. Last 4 years, he has not stayed in India for 1 year, so he becomes non-resident. So he comes and goes, but this resident part he is not matching. Some company controlled from India, he is working in USA, let us say. He got salary in USA. He need not pay tax because he is non-resident. But if he is a resident, he has to pay tax. That is the thing. And income other than above, that is income which has no relation with India, naturally not taxed. This is for non-resident. Resident, you have to pay tax. Wherever you get, you have to pay tax. So now with this, we are completing first part of the income tax calculation related basic rules. We'll see the remaining part in the next video. Until then, namaskar.